But before we start, how about a few housekeeping items that I just wanted to go over. What we, as you will see, we have most of the participants muted, and you know what, even the videos are just off just for better recording quality. So as a courtesy, if you can keep the mics muted, that will be much appreciated. And obviously towards the end of the panel or discussion, we'll go ahead and turn those on and have a live discussion. So happy to take questions. Please go ahead and post them in the chat throughout the session. We'll try and find some time towards the end to address those and get some of those answered. How we have laid this out is that we'll have about an hour of panel discussion, followed by 2 breakout sessions, actually, because Abhishek has to leave. So we'll have 2 led by Ken and Christina. And thank you in advance. This is really gracious of you to be offering that extra time. And this is for folks who want to stick around and get FaceTime with them and ask them questions directly and get those answered. So this is a really nice thing that I think, given the current environment, we're able to offer our participants and make sure that we can get, to whatever degree, get a feel of having a one-on-one conversation. So thanks for that. So without further ado, let's dive in. Welcome to another session of our webinar series for TechCon SoCal. We are really happy to be reaching out to you all with these series and hope that everybody's finding them beneficial. So our mission at TechCon SoCal is to bring great minds together. This is exactly the kind of platform we want to provide for everybody to connect and bring the entrepreneurs, the investors, the researchers, all of them together, and industry experts, and have the dialogue and be the catalyst for the tech ecosystem and tech innovation in Southern California. With that, thank you for joining. Thank you everybody for coming and being part of this. My name is Anika Hijazi. I'll be your moderator today. I am one of the co-founders for TechCon SoCal. By profession, I'm a CFO, most recently with a startup called Equid Inc. in the SaaS e-commerce space. I on the side advise startups, and I serve on multiple boards. So that's a little background about myself. Our topic today is what I find really interesting. So it's investing and fundraising in the current environment. And we all know how the current environment has changed, right? Quite relevant given the ongoing turmoil of the pandemic. And while the world has shaken, and these are unprecedented times, today we'll discuss about what that impact has been on the financial ecosystem and more specifically on the venture capital investment system. So let's get to it. Please join me in welcoming our esteemed panel. I'll go ahead and introduce the 3 folks who are joining us in our panel, our speakers. With us today, we have Ken Denman. Ken is a partner at Sway Ventures. He has decades of CEO experience. Previously, Ken was co-founder, president, and CEO of Emotion, which was actually a San Diego-based startup that was acquired by Apple in January of 2016. He was the CEO of OpenWave Systems. Prior to that, he was the chairman and CEO of iPass, which he successfully led through an IPO. Ken was also the SVP for Media One. He serves on multiple private and public boards. And to note some, he's actually one of the board members on Costco Wholesale, Lending Club, and Motorola Systems. Ken is also an affiliate professor at the University of Washington's Foster School of Business. Ken, a pleasure to have you here, and thank you for joining us.
Thank you very much. It's great to be here.
Next, we have Christina Serafin. Christina is a managing director at Verizon Ventures. She joined Verizon Ventures from their big data and AI product team. Prior to that, Christina was the director at Intellectual Ventures, where she led investments in machine learning, media, advertising, and gaming technologies. Her own entrepreneurial experience includes co-founding and leading 2 software companies from their inception to acquisition. She has spent several years on the strategy and corp dev at IBM. Welcome, Christina. Thank you for joining us today.
Thank you.
Last but not least, our third panelist, Abhishek Shukla. Abhishek is the Managing Director and Global Head of Venture Investing at HP Enterprise. Prior to HPE, he was the Managing Director of Software Investing at GE Ventures. Sorry, did I hear something? Okay, so continue. So prior to that, he was the Managing Director of Software Investing at GE Ventures. Abhishek is also, Abhishek, I didn't know that, but you were also ex-Cisco like myself. And so he was a part of Cisco's Corp Dev team, focusing on the 12 billion services and solutions portfolio. And in his prior career, he held multiple leadership positions at Agilent, Sony, and SAP. Abhishek too serves on multiple boards. Glad to have you here, Abhishek.
Thank you, likewise.
Perfect. All right, so to get things kicked off, I thought it'll be interesting and worthwhile, and it'll, our audience, our participants will actually benefit and appreciate how you all bring the different perspectives. So how about you share what your company's investment portfolio or philosophy is, right? And for instance, what stage do you guys invest in, what area, and typically what's your check size that you're writing, so that way our participants and our audience can see the different perspectives you bring in. Yeah. Ken, do you want to start?
Sure.
And then just go around.
So at Sway Ventures, we're a relatively young venture capital company. First fund circa 2013, 2014, about $450 million under management across two funds, Core Fund 1, Core Fund 2, and then we specialize in allowing our LPs to participate via SPVs, and so we have kind of equal split between sort of Core Fund 1, Core Fund 2, and then SPVs, so that adds up to the 450. We are focused on largely on software at the core. So we are strong believers in, our theme is that software will liberate us from the tyranny of inefficiency. And so we're focused on understanding some of the hard technologies, machine learning, deep learning, blockchain, you name it, all the sort of the enabling technologies and how they will diffuse into traditional markets. But at the core for us, it's really about software. Our target investment, if you look at the bell curve, we're about 70% Series A, 15% seed, and then another 15% in sort of Series seed. We do basically 1-for-1 reserve when we go into an A, and to make sure that we can back the company and do into the B rounds and or the C rounds. But we're relatively early stage compared to most, and we kind of, that sweet spot for us is Series A. I'm standing up something just recently called Sway Studios, which is an incubator where we're actually looking to incubate companies, within sort of the family or people in our extended family. So I'll stop there and turn it over to Christina.
Thanks, Ken. Yes, we are the corporate venture fund for Verizon, and we're also early stage focus. Series, I would say that we rarely do seed round, but we have done a couple. Seed being pre-revenue, pre-launch. Most of the sweet spot is in the Series A, Series B round, sometimes Series C. Well, I shouldn't say rarely, never really growth stage or late stage investments. And our average check size is 3 to 5. We don't lead investments. We co-invest with other strategics or other financial investors. And we are interested in a number of different technology areas that are strategically aligned with Verizon.
And Christina reminded me, because she gave a full answer and I forgot to mention the average check size, which for us is right in that $5 million range. We'll go up to $10 million. We've gone occasionally, but generally it's in that sort of $5 to $8 million range for check sizes.
Okay, so I think I can go next. First of all, thanks for giving me the opportunity. It's great to have you guys here. My name is Abhishek Shukla, and in terms of HPE, Hewlett Packard Enterprise, obviously we are not the printer and the ink company. We are the other guys. I run the venture investment team, essentially looking at investing in areas which would be strategically relevant for HPE. In terms of our investment focus, I would say we are a little bit later stage. So we don't do seed. We are stage agnostic technically, but start from Series A onwards. But where we can really help and actually differentiate for our portfolio companies is probably Series B, call it when the product market fit is achieved. That's when the people know what to do. That's when the channel which we bring to the table knows what to do with the company. And we believe in making 1 + 1 = 3 as the mantra around our investing. So that yields us to a very flexible check size, as you can imagine. So right from 2 million onwards, which is probably the lowest check we'll write, all the way to upwards of $50 million check, which we wrote last year, single check, and we obviously reserve for our follow-ons. We look at deploying about 100 million a year. So think of us more like, for the life of the fund, about $1 billion fund, still out of balance sheet, not exactly carved out as a separate fund, but fairly flexible in those terms. And in terms of the investing areas, clearly very wide, but things which are interesting engineering problems from, silicon, networking, storage, compute, as you would imagine for HPE, but then quite a lot of things around the cloud, networking, cybersecurity, edge, and then the whole, we call it data to AI. So where the data is generated, how it's managed, tagged, mapped, all the way to you running the fancy models on it and achieving those results on those. And then there's a huge business around Aruba, which HPE owns. So that is around edge. So a lot of Wi-Fi networking, switching, 5G, edge cybersecurity, IoT, enterprise, and industrial. So the mandate is fairly wide. Looking forward to the session. Thank you.
Okay. Thank you. Thank you. So that kind of sets the stage in terms of the lens that you guys bring. Now, let's talk about the current environment, right? Nobody thought we'll be where we are. Nobody thought we would experience what we just experienced in the last quarter and a half, if not 2 quarters now. So, talking about the current landscape, data shows that Q2, which was, if you think about it, the first full quarter in the new COVID world, right? Data shows that we were about 12%. There was a 12% decline in venture capital investment quarter-over-quarter in North America. And I want to understand from your perspective, how has that pandemic impacted your company's investment strategy, and what are you seeing across the board?
Well, I'll wade in. First and foremost, as the pandemic and the impact of it began to become more clear, the first thing we did was make sure that we huddled across the board. We have about, something like somewhere between 77, I think it's 77 ventures that we've funded over the number of years. And so for the partnership, it was about, huddling up with all of our companies and their boards and really thinking about runway, like how to extend runway. What were the tactics? What were the strategies to make sure that we extended runway? Because, whether you have a struggling business or a great business, the uncertainty, the ambiguity about what the markets look like going forward were the biggest threats to investors' capital. So for us, we wanted to make sure that everybody, we gave everybody the greatest opportunity, to achieve their goals. And the biggest sin in the venture space is running out of cash. So for us, it was all about how much runway do you have? What do we do to extend runway? How can we make sure we get through this very difficult tunnel? So that's job one, and I'll stop there and let Christina wade in.
Yeah, definitely. Similarly, when the pandemic started, we took a scan of our portfolio, like probably most investors did, and try to understand the unexpected needs for the portfolio companies first and foremost, and how we can address those needs. And but probably after about a month and a half or to 2 months into the pandemic, we started to refocus on both portfolios was new investments. a few months since March, April, we've closed a number of new deals, and we've also done a lot of follow-on investments. I would say my expectation for the end of the year, it would be that as compared to previous years, a greater percent of the fund will be focused on supporting portfolio investments, but at a high level, we still will have a pretty good, healthy amount of capital available for new investments as well.
Yeah, so I think similar sentiments here as well. Obviously, the first thing was to take stock at what portfolio company needs help. How can we extend the runway? But broadly, what I would say is one thing was surprising for me in the whole pandemic piece, which was the number of companies, the number of opportunities, call it a COVID race, quote unquote, became really commonplace. So for us, it has been a really busy time. It's about, how many companies which we were fielding every week has, I don't know, probably doubled or tripled some to a certain extent. Now, obviously, you go through each company and figure out if this is a COVID raise or if there is a growth opportunity, just like as you would in a normal time. But especially in enterprise, what we have seen, and if you were a hardware or a silicon company, when the cycles are really long, then people, irrespective of how long their cash runway was, were absolutely open to raise more capital. Therein presents more opportunity for both sides if the value can be created. So that's what we are finding ourselves into. A lot, later stage companies raising, clear established companies raising. At the same time, we are working with our portfolio companies to make sure that they do have a runway once we all come out of it in all this uncertainty.
If I may just add on to that, to both of those two comments, if you get past that, I commented on the initial, sort of our initial thought and kind of how do you react. An interesting phenomena that we saw in our portfolio, because we are largely software and we had to invest in a number of companies that were about enabling, mobile capability, extending mobile capability, and in some cases extending virtual capability. And those companies, we actually have seen an acceleration of their ARR, of their ability. I mean, they figured out how to continue to sell on Zoom calls and how to continue to engage with customers virtually. So we've, while there are some companies that were certainly under stress and we had to, you had to sort of do triage and work hard. It was very interesting to see that some themes that we've all felt have been inevitable, but that we're sort of cranking along at a certain pace, never fast enough. All of a sudden, we've seen an acceleration.
Yeah, and I can kind of vouch for that because Equid, the company that I was last with, we just raised 42 million. And because it's an e-commerce company, it's an e-commerce SaaS company, the environment was right, the focus was right. I mean, everything aligned so well, and we ended up with a great funding round. So that certainly shows that everything is not gloomy. There's certainly opportunity that lies. But out of curiosity, just kind of expanding on the same topic. So when the crisis hit, there were probably current deals in the process. Did you guys just halt for a moment? Did you turn them away? And then when you talk about that runway, just kind of give us an idea. What were some of the things that the companies did? Hiring freezes? What was it? Did you see layoffs, or was that just a knee-jerk reaction? Just kind of expand on what were some of the things your portfolio companies were doing to adapt to and kind of extend that runway.
And it varied by industry, as kind of both Ken and Abhishek alluded to the fact that some industries have benefited from the dynamics of this pandemic. Others have suffered negatively. So there are companies in, I'd say it really very much depended on the pandemic. Companies in the live streaming space, or we looked at and made some investments in sports tech companies that are providing essentially an alternative way of experiencing a game, let's say in the sports context, when all of the live sports events are canceled. So gaming as well as an industry that's benefited. video conferencing, we already know about that, but there are a certain number of, and then there are other companies that have not been, maybe did not benefit, but were not affected greatly, that were in the enterprise SaaS space or AI, for example, that continued to grow on the path that they were on. So they didn't have to take any drastic measures, as opposed to some others that, for example, we have an investment in the location-based entertainment space that was greatly affected. And there are certainly companies and some industries that were negatively affected by the pandemic that had to take drastic measures like layoffs and cutting back and really just making a significant turn in on their path.
Yeah, I would agree with that. Similar, there were a range of implications depending upon which industry the company was in, what their stage was, and where they, kind of how much capital they had on the balance sheet. And so, on the one end, there were instances where teams decided to contract the size of the team, stop hiring. There were some teams that where the senior members took pay cuts. They just sort of looked at everything that they could possibly do to extend their runway, and others had less draconian, could take less draconian steps, but did other steps that were focused on other things that they had. There were several of our companies that were in the SIBR pipeline and were able to complete phase 2 SIBR deals, and that was hugely helpful. Where they accomplished 1.5 million or 2 million, and the people around the table, fellow investors, board members, VCs, basically stepped up and provided matching funds because it was obviously a solid return. I will. One of my situations outside of my Sway role was a company that I co-founded up in Seattle back in 2016, and it's a virtual reality for surgeons, for lack of a better term. It's this team that we pulled out of the University of Washington, and we had received and I'm just gonna tout these guys because I think they're so credible. We received a term sheet from Data Collective, mid to late February, and there's not always honor across all VCs, and I was sort of sweating bullets. I wasn't sure what the implication would be. But they never wavered. They never changed the terms.
Wow.
And we closed that round late April. Was it mid to late April? We closed that round on the original term sheet. So I think that's an example of a top-notch, top-class organization. And you don't always see that. So I definitely thought I would mention that Data Collective team because I think they're awesome.
Amazing.
Yeah, no, I agree with most of the comments. I think from our perspective, as the pandemic hit, obviously there was a lot of unknowns. There still are, and we were trying to figure out in terms of the new investments, what are we looking for? And an easy yardstick was they should have at least enough cash. And again, define enough cash you can define until eternity. We thought 2 years might be a good idea. So we started looking at companies when we were, the first question I will ask is, well, how much are you raising? Is this going to suffice plus what you have at least for 24 months? If that is indeed the place, then we have the conversation. If it's a small round, we just want to, add for another 6-month burn. We kind of knew that we'll be standing at the same stage in about 6 to 12 months time. So we avoided that. A little bit of going later stage also helped us. This is a time when you could see the enterprise sales motion being kind of reinvented to what can allude it to using Zoom. And some companies have actually done really well, and the amplification was really fast and was visible in the matter of, call it 15, 20, 30, 35 days. That isn't a trend, but at least some patterns emerge. And we were able to, look at some of those. So from our side, apart from this, fund, the amount which they are raising, there isn't any other yardstick which we were looking at. And it has been kind of business as usual. Obviously, we have kind of started focusing more on the later stage than in the earlier stage, because the risk and a lot of other things are much greater. And, you know, in a pandemic, it just, you know, it gets accelerated, both sides.
Mm-hmm. No, I think that sounds good. But talking on the same terms, I know that you're more later stage, but Ken and Christina, how have you seen valuations getting impacted? Because I know it depends on the industry and exactly the kind of opportunity, and it may vary significantly. But in general, the early stage valuations, how are you seeing that getting impacted because of the pandemic?
Christina,
Yeah,
you can weigh in first.
It doesn't matter. You started this trend, so go ahead first, and I'll go second.
What I would observe is that for the top quality companies, we are not seeing a significant impact on valuations, because there's still competition for companies that have the right theme, the right team, and the right traction. Those deals are still very competitive. You know, where you may get a discount is where you're rolling the dice, where some element of that is not the case. But, you know, what I have not seen a serious degradation in valuations from the deals that we've looked at. And I literally just signed off on a deal this morning. It was one of the kind of few. It's a pre-seed seed deal. It's kind of my first deal out of my Sway Studios. And I would say it was a very fairly priced deal. And I think it was priced about where it would have been priced 6 months ago, because the team is very strong. The theme is very strong. The opportunity is huge. And, you know, if they can execute, this will be great. And they had other options. So, you know, that's always gonna, you know, that's always gonna be the case. If you can create an auction, you know, you're going to get fair value, and that's my observation. I think companies that are struggling, those are going to be the situations where the discounts are going to be, you know, frankly, brutal.
Yeah, completely agree. And so the companies that have been able to, that as Ken mentioned, are strong, and they would have been able to attract investors regardless of the current situation. We haven't seen any big adjustment in valuation. We have seen an adjustment in valuation in the other direction, though, in some of those industries that I mentioned that have been able to leverage the increased demand from consumers or customers in general due to the pandemic. And there's been an slight increase in valuation, as well as an increase in interest from investors as well as customers. And then the industries and companies have been negatively affected. And yes, in certain cases there has been an adjustment in the valuation, but it's primarily due to the fact that, well, first they're not able to you know, they're everything is affected around their business, and inclusive of investor demand, and hence it trickles down to the valuation.
Yeah, just to add, you know, might be worthwhile for everyone. I had my team members do it or look at the overall VC trend analysis a little bit in the pandemic, and interesting things, kind of obvious, but emerged to us, which was, you know, to what Ken and Christina was saying, the early stage is actually shrinking. So if you look at last year versus this year, the total number of dollars deployed, it actually went up, which is, you know, contrary to what I thought would be. Anyways, but as you double click into it, you very quickly realize the early stage was shrinking, as in, you know, the really good deals were very competitive, like Ken alluded to, and were still getting done at a pretty awesome valuation. But there was a lot of other companies which were standing on the fringe, which were not able to raise, or just, you know, left their rounds for later. The other part was actually flipped, which is, as you get into the later stage companies, you know, the VCs were looking at doubling down on their winners, obviously. So, you know, more and more capital chasing some of those later successful deals. But then companies which were either call it runaway success or were determined to be successful in this domain are and were able to command really huge premiums and were able to raise even larger rounds. And you know, we participated in some. I can't outline the name of the company, but it's the company was thinking of raising. Started with 50 million, went to 60, 70, 80, 100, 110 million. The interest was still there. Another company wanted to raise 300 million. It took them less than 3 weeks to raise 300 million. So the capital has not evaporated. It's just lying there waiting for the right companies to arrive. So if it's a better, good later stage company, it's actually a fabulous time. It's unfortunate, but it's interesting.
No, I completely agree with that comment. You know, we're raising our first growth fund to back our winners, you know, the sort of strongest platform companies out of Core Fund 1 and Core Fund 2. And because of the dynamic that Abhishek just described, we're actually going out to those companies that are doing, you know, extremely well and, you know, that are later stage and maturing fast. And they are not actually raising capital, but we're actually pitching them now early before they have to raise capital. We're saying, hey, do you want to take some capital now? Because we know if we can get in front of the line, if we can get them to you know, sort of say, look, you don't want to have to be out there raising capital in, you know, 6 months or a year. Why don't you put this to bed now? You know, let's sit down and talk terms. Let's start our underwriting process. Let's get to know you better. So we're actually trying to get ahead of the wave because as was just described, it's pretty competitive for those strongest companies.
Wonderful, wonderful. Yeah, it's a great dynamic and great time to cut a deal if one can, right? So Abhishek, I'll direct this one to you because HPE invests globally. So interestingly, while in North America, right, if you look at the data, it shows that yes, Q2 was a down quarter. But if you look globally, depending on where you look at the data, they've shown globally, VC investment has shown great resilience, right? In some cases flat, and some reports actually even show it being up compared to Q1. So especially compared to the other economic trends and impacts, right? Where you look at employment and, you know, the market, travel restrictions. So I want to understand what trends are you seeing in the regions across the world, given that you guys also have that global lens on?
Yeah. Yeah, no, that's a good question. It's, you know, and again, I will, you know, filter my response because we look at enterprise only. We don't look at consumer, which is where a lot of, you know, big deals get done, which you hear in the newspapers. But, you know, especially in the enterprise side, it's actually an interesting phenomenon. So US, I just described how that is doing. You start looking at Israel, it's actually mirroring the US. So, you know, larger rounds getting done for successful companies. Early stage companies are either somehow trying not to raise or trying to raise and flip it to the US very early. Those are the two major enterprise hubs, India being the third. India, on the other hand, is in a trend of, this is the boom time for enterprise startups. So, you know, people all understand all the consumer companies and how much millions and billions they've raised, but a lot of talent came out and figured out that, you know, they could raise, they could create enterprise software companies. And that is being addressed. So if you looked at, because it was fresh and I was looking at it, was a company like Postman, which was, you know, which just raised at a 2 billion valuation, a company starting in India, only enterprise, nothing to do with consumer, and actually made it successful in less than 45 days. Go into Europe, it's actually slowing down. You know, the folks, even the growth investor wants to come into the US or in the Israeli deals. The early stage ecosystem is very, you know, I won't say they've stopped, but they're very cautious. You know, but then there are pockets of countries where they are being helped by the local government. So look at France, for example, or Italy, where the government is helping, you know, call it the equivalent of PPP in the US, but with less onerous terms, and government is okay to put in, you know, a significant amount of the capital. In that case, the VCs are okay to go, you know, step up even in earlier stages or mid stages. And broadly, Southeast, we don't do China, but broadly Southeast Asia and Japan is kind of it's not that fast unless you're a consumer company. Enterprise, you are still in a wait and watch mode. Not much is getting done.
Interesting. And that goes in line with what I've read about it, and call it timing or whatever. But I think the next second half of the year will be interesting for the different regions as well. So we'll keep an eye out on that. Now let's talk about a little, an exit strategy is obviously a big part of the equation and the overall plan for any startup, right? I just want to hear, given this current environment of lockdown, shelter in place, all of those requirements, what are some of the operational challenges of an M&A that you guys are either seeing or hearing about, and what do you think companies are doing to overcome them? These are, with life not being as, the old way it was, what are some of those operational challenges for an M&A?
Well, I would say first and foremost, and this was, a real lesson that I should have learned in one of my many lives, before my last startup, and it became clear to me that when we engaged with Apple at Emotion, when we sort of began to get inundated by all the names, Apple, Samsung, Qualcomm, Google, etc. And as a company that was focusing on facial expression measurement from which you could infer emotion, and it was really about sort of computer vision, machine learning, deep learning, and behavioral cog science. Obviously, the core of what we did was create really strong software algorithms that were deeply rooted in quality data sets, et cetera, et cetera. And once we got into the process, it became clear that the strength of the data room was incredibly important. And if you're running fast, running hard, you're building a business, sometimes you forget how important it is to organize the information and the data. And particularly if you're a data company, your data sets and your ability to demonstrate that you actually own, what's the provenance of those data sets? Do you own the data? Do you have the rights to the data? Where did it originate? All of those things are critically important in an M&A process. Those are the things that those companies want to, they have to nail that. They absolutely have to nail. They'll get into the other stuff. How much open source do you have, et cetera, et cetera. But the efficacy, the effectiveness, the ownership, and the documentation around the data and the data sets is paramount. Generally, I would say you got to pay attention to your nits and bits. You really need to make sure, because when those companies, so where I'm going with this is, I actually think that, it's not this environment is not harmful because those data rooms are virtual, but do the work. That's what I would say. If you're going to be going into a serious M&A conversation, make sure you dig in and do the work to present your best side, because you can turn somebody off if your data and your data room looks sloppy. That'll cause them to walk away.
And Ken, you nailed it, and I couldn't agree more, because myself being a CFO, I can tell you I've been on both sides of the coin on that discussion, and I've said repeatedly, you've got to be data room ready, because when the moment is right, timing matters. And generally speaking, as a startup, you're going at a pace where your data set, accounting, finance, books, housekeeping, all that is an afterthought. And all of a sudden it becomes very critical when time is right and you have the term sheet and you need to close it, and now you're figuring out how to even create it in the first place. So
that's right. And we were fortunate. We had these amazing, my six co-founders, research professors from UCSD, plus the 4 other PhDs that we picked off when they did their defense, because our folks were their advisors. We were really pristine on the data. There were some other aspects of the business that I have to own where, our data wasn't as pristine, and we had to really scramble and get it right. And I had so we did that, but it was hectic because, I knew that first impressions were going to be critical. So by the time we gave people access to the data room, we were clean, but I had to tell you, there was 2.5 weeks of sheer hell to get there.
I know exactly what you're talking about. All right. So in the interest of time, let's kind of shift our focus now and let's talk about outlook, right? And you know, nobody has a crystal ball. And the one thing at least this pandemic has taught us is never take things for granted, and things can change rapidly, literally sometimes overnight. But that said, we'd love to hear what your venture funding outlook is. What do you think second half of 2020 will look like, and 2021? So I'll just open it up, and Abhishek, you want to start, and then we'll go around.
Yeah, sure. Yeah, no, I think it's so let's start with the first 6 months, or probably in the fall or going into the winter. You know, at least in the U.S., unfortunately, the U.S. elections are going to take a huge precedence as well. So deals which are going to get done before November will be easier because the uncertainty is only for coronavirus. You know, after November, who knows? So it's basically whatever deals we are right now looking at or talking to, the keen eye is to try and get it closed before November in all respects and terms. Overall, the early stage, I think still is still a little bit of a challenge. Medium stage, call it B and C's, are we are at least now seeing more of those than I was seeing, you know, 3 months ago. But again, that might be my own perspective or biased one. Later stage is you know, as if nothing happened. Moving forward, probably in 21, I think you know, a little bit of normalcy will return. People will understand and appreciate living in a pandemic, and you know, working remotely and doing deals on Zoom, which all of us have now already done. So that scare factor is now gone. You know, you can actually be productive. You know, you don't have to sit down across the table and you know, shake hands. There's probably another way of doing it. While, you know, you need, like what Ken alluded to, you need tremendous confidence on the founding team in order for you to do so. But I think that is where people are headed. And I think, you know, 21, if vaccine and all these things happen, I think it's going to look way brighter than what it is today.
Great. Christina, you want to?
Yeah, no, I agree with that opinion. I also, you know, there's kind of the opinion about the outlook on the market overall versus the outlook on for our internal objectives and how we expect to behave within our fund for the rest of the year. And I think not that the two are distinctly different, but for us, given that we're a strategic investor, we are looking for the right companies, right strategic fit with strong strategic value. On the financial return side, we expect financial return, but we have a little bit more flexibility around the timing of those expectations. And so for us, on our day-to-day hunt for the right companies to work with and invest in, not a lot changes necessarily. It's still finding the best companies with the most relevant technologies that are strategically relevant and financially stable, right? But again, we don't expect the multiples or the in return, or the time frame for that return is a bit more relaxed. And as far as the market outlook, I agree with Abhishek, summarized it really, really well in terms of some of the uncertainties and some of the overall market dynamics that I think we that are on our mind without knowing, you know, except without having the crystal ball to know exactly this projections.
Yeah, I broadly agree with those comments, and so I'll try not to repeat them. But I would say there's something that's ticking away in the back of my head, which is the overall broad market. I really, you know, my gut, and when you look at the percent, you look at the sort of public market valuations, and then you parse it just a little bit, and you figure out that, you know, across most of the index, there's sort of 7 to 10 companies that are holding up those indexes. And if you go below those those 7 to 10 companies, there's a lot of fragility. I don't have a crystal ball, but my gut tells me that we are looking at, sort of a realism to set in, irrespective of what happens in the elections, although, the elections are certainly be part of this, but the realism is going to set in sometime in 2021. And we're going to see, pretty big haircut in the public markets. It may be a correction, I may be more, I don't know, but it's going to be a little bit breathtaking is sort of what I'm trying to plan for. And if there is a 35% haircut in those markets, typically what happens is venture freezes, because exits, the perception of exits begins to look a little more dour, and people once again look for more runway, and so they protect their babies as opposed to maybe looking for new ones. And so I'm that's probably the thing I'm most concerned about, is more than a little correction. I mean, a big correction in the public markets that freezes the markets for a couple quarters.
Interesting.
Yeah, I mean, one thing I would add that I'm seeing, I mean, this is not a projection, but I'm seeing a lot of fundraising out of fear. Companies pulling their fundraising rounds forward. They are raising strategic or in between growth rounds, whatever you call them. Rounds they weren't planning on raising, but it's a little bit out of fear and trying to raise as much capital to account for some of the concerns that Ken just talked about.
Okay. All right, so let's talk about the big question that's on every entrepreneur's mind, right? In this environment, how does an entrepreneur, what do they need to do to raise funds? And again, I know it goes back to what industry you're in, and what's the demand and where you are and all of that. But in general, for the benefit of our participants, and I don't know exactly what stage our entrepreneurs are, but what would be your advice? What do they need to do given the uncertainty, given the environment that we're in? What's your advice? What should they be doing to raise funds?
Well, I would say the thing, Abhishek mentioned this earlier in passing. For me, it is about, the highest priorities for me are those that can demonstrate product market fit. If they can validate product market fit, I'm really interested, because now I know that the dollars that we invest that go to sales and marketing are actually going to be well spent. I see a lot of teams that gear up to do sales and marketing when they haven't validated product market fit. Mm-hmm. And that's just, pissing money away in my experience. And I've seen it so many times where I've just, it scares the heck out of me. And there's normally a lot of pressure from people like me, from VCs. It's like, go fast, go big, or go home. And often pushing teams, or the teams are doing it themselves, they're putting the accelerator on sales and marketing before they're really ready to go spend that money effectively. So to the extent that you can demonstrate and that you have validated product market fit, that's one of the things that, I will make a lot of time to talk to those teams. So I'll just offer that one and let the others wade in.
Yeah. No, I completely agree with Ken. So, product market fit is something which absolutely stands out. The other thing is, the long-term outlook as it automatically yields to from the founding team perspective. They should be looking at solving this problem 24 months, 36 months, whatever it takes, rather than, go big, go fast, or the traditional Silicon Valley mantra of fail fast. That, especially in a pandemic, trying to build an enterprise business is hard. Mm-hmm. And to start it is even harder. So my thinking is, before founders waste any time with VCs, their own precious time, get to some substantial scale, not substantial, get to some demonstrable scale that the dogs like the dog food. Once you get there, that's when the things will start Don't worry about fundraise. Worry about building the company, and then fundraise will happen, especially in this time.
Yeah, I would agree with that. If anything, I think it's definitely a harder time to start and validate a company, but it also kind of buys you security in the long term, because I don't know, I was actually I started one of my startups in the 2008 recession. Perhaps this is going to be a bigger one, but from firsthand experience, I know that it seems harder when you're doing it, yet when you look back at it, it does seem like you definitely find a stronger product market fit. You definitely validate more things that might slide by in an easier environment when venture money is easier to get to, but in the long run, it may not serve you the best.
Yeah, Christina just really hit on a very, I think, real issue / opportunity. You know, her words are really prescient, which is basically, if you look at the 2001, you know, sort of the first internet bubble, and then go look at, you know, sort of 08 through 011, those really difficult times, there were some of the biggest companies came out of those windows. Deepest, darkest times, some of the best companies were created in harsh times. And so it really is, those are really times to focus on. If you look at Zoom, for instance, as they throw out one name, you know, but there's a whole bunch of them that started in the worst times. And I think one of the reasons that they were able to gain success in those windows, like Salesforce came out of the, you know, 99, 2000, is that they did what Abhishek said. They just focused on building their business. I don't think they were out raising a lot of capital, because there wasn't a lot of capital to be found. You know, they just, you know, kind of pulled themselves up by their bootstraps and just figured out how to muscle through and build businesses and get to a point where they could demonstrate product market fit.
Wonderful. So as investors, what is this one? And I know it could be the flip of what you just said, where there isn't a good product market fit, or they're not looking long term. But maybe talking a little bit on the softer side, what is the one mistake that you repeatedly see entrepreneurs make, and you just kind of wish, you know what, I wish they just didn't do that? Is there something that you guys can pinpoint? Is that one common mistake that you would just advise them not to do?
I don't know how common it is, but we do see sometimes companies, commonly enough, that spread too thin. And for example, I've seen a number of companies, including some in our portfolio, that have, let's say, an enterprise-focused product, and then they also try to extend that direct to consumer, and they try to pursue both, and it's really like starting 2 or 3 companies at the same time, as opposed to just having a much more narrow focus. I mean, it is technically the same offering, but getting users and validating that with consumers / users is very different than trying to sell into enterprise companies. In terms of reaching out, so that's kind of more of an operational quote unquote mistake. In terms of the fundraising side, something we see often is, startups may not understand the investor focus, or have spent time researching it, or talked to their network about what the focus of the investor is. And sometimes you have conversations, oftentimes you have conversations that are not necessarily, they don't necessarily fit with the investment themes. So the more you understand the investors and their current focus and prior focus and so on, the more effective and useful the conversation will be for both parties.
I think one thing which I will add is, which I see, especially in enterprise side, is people trying to solve what I describe as a high class problem. And by that, what I mean is, people are trying to look at, okay, if I do, if I solve this software problem, and I'm going to pick up Kubernetes or the cloud cloud infrastructure as an example. People building company on the cloud infrastructure, thinking about the growth and all the things which is happening and accelerated by the pandemic and so on and so forth. Spending a lot of time on that company, only to recognize that the fundamentals of having, let's say, Kubernetes focused ecosystem really right isn't even there. So you end up then spending a lot of cycles educating the people of where they should be headed. Whereas, you can't always you can't always time the market, but in enterprise setting, you can't survive until you time the market somewhat rationally. Otherwise, you will die trying. That's a real unfortunate truth.
Mm-hmm.
Yeah. Plus one on both of those. The focus issue that Christina mentioned, and also the issue that Akshay just mentioned, they really are kind of focus issues. And especially when you're small, I see young teams trying to do too much and being unable to make a decision about what they're not going to do. That always scares me. But I would say that the thing that I would offer is, I see companies trying to mimic product market fit by, through pricing. They basically, sort of give their service away longer than they should, or they're unable to, or they don't want to, demonstrate that they can collect value, and they get themselves in a situation where there's just not enough skin in the game by the customers. So you can't really tell if the product is delivering value or not. I mean, you can do other work to try to get there, but that's one that's sort of deadly, because you can kind of convince yourself that you've nailed it and you're making progress, but you look under the covers and it's not really, there's not enough skin in the game on the customer side. So you can't even get great feedback because they're not even spending time. So anyway, this is one that I look for teams that have the confidence in the right way to ask for value and to get it. And I can look at a bunch of other metrics, but at the end of the day, if I peel the onion, I want to know if people are you solving a problem that the market is willing to pay for. And you can hide for a while on freemiums and other models, but eventually you've got to demonstrate that there's a value proposition there that's going to deliver returns.
That's great. No, that totally makes sense. I know it's almost 6, but there's one last question, which I think CEOs will find really interesting. And I want to address this to you, Ken. As a former founder turned investor and somebody who has decades of CEO experience, what would be your advice specifically for CEOs and how to be more resilient as they face an economic downturn? Because I know we talked about entrepreneurs and that ecosystem, but if you think about a CEO, and it could be any stage, how do they face this, and what is it that they should have done based on your experience?
I think the most important thing is to make the hard decisions fast and early. There will be a tendency to try to not, to hope and pray that things won't be as bad as they appear to be. And that's just deadly. If you see something coming like this, similarly back in, I'm old enough to have been through enough of these cycles. And I know this sounds pessimistic, but things are typically worse than they appear. And you have to assume that. And make your decisions to give your business and your team and your investors the greatest opportunities for success. So you need to move quickly and you need to move deeply. And what I see younger, less experienced CEOs is they try to increment through it. They say, okay, here's my plan B, my plan C, my plan D. I'll wait till this milestone and then I'll make that next decision. Then I'll get to this next milestone, I'll make this next decision. You need to make the important big decisions early and fast, and get everyone sort of realigned around the new reality, and then hunker down and focus. That's one of my biggest learnings. I have made the mistake of trying to live on hopes and dreams, and 99% of the time, you get crushed.
Doesn't work out. Yeah, no, those are words of wisdom. So at this point, you know what, we will stop. Thank you so much. We will open for questions. So let me expand the chat and try and see which if we can address a few of these. Okay, so one question is, would you ever mentor a company that you denied investment to?
I am. So the answer is yes, very selectively. You know, venture is about partnership. So you may feel very strongly about a particular company. You may, you know, even have pounded the table and not carried the day. But if you feel very strongly about the team and the opportunity, and you've engaged with them, especially if you know them from past lives and you really think that they've got something, then what I will do is I'll say, well, you know, here's my feedback here, and I will introduce them to other VCs. I'll do the warm introduction. I'll use my network. I'll do everything I can to help them get funding. A, because I believe in them, and B, you know, down the road there may be another chance to invest in them, and they're going to look very warmly on someone who's helped them out.
Yeah, I would agree with that very much. Oh, sorry, go ahead.
No, go ahead, Christina.
I mean, I was going to say that, especially within our world, being a strategic investor, we are somewhat limited to the areas that apply to Verizon, and sometimes we will see companies that are very compelling for all the reasons Ken mentioned and so on, that personally I believe in, but it may not fit the investment thesis because of the area of the technology or the stage of the company. So similarly, would definitely selectively, but definitely would spend some time and effort in helping them out.
Yeah, just gonna say it's a very small ecosystem. Everybody knows everyone. The founders, start. It's a network which you build on both sides, and you know the more. Again, you don't do that for every deal. You look at companies, and you figure out where you want to tailor your energies. But I try and at least, you know, because of the stage or because of the of the investment interest, we decline a lot of deals, but we do try and make those introductions, because what comes around and goes around, you know, karma.
Yeah, couldn't agree more. Okay, so there is this one other question which is interesting. It says, how do you think networking or meeting new investors has changed in this more remote period? Any tips on how to get the first conversation started?
It hasn't changed. You know, warm introductions by people I trust is the best way, and oftentimes the only way, because we all get, we get a ton of blind reach outs all the time, and I rarely look at blind reach outs. I just don't have the time. It's just too much going on. And so but you know, if somebody that I know and trust, and you know, if they reach out and say, hey, I'd like to make this introduction, I think this is an interesting team, and you know, because it is, you know, as Abhishek said, it's a small world, and you know, you have to keep, you want to keep your friend network and your respected colleague network tight, because we help each other. I will take that introduction. I will take that call. But blind over the, whether it's virtual or not, I just don't have time.
Yeah, I would agree with that. Absolutely. And it's a tough one, because it's just how the things work because of lack of time and overwhelming amount of, you know, companies and interests to look at. But we've been talking in our team a lot about diversity and how to support companies that have lack of access to the investor network, because it is a small community, but then that is also, unfortunately, cutting out a lot of people that don't belong into that community.
Great point.
And so entrepreneurs are resourceful, and you do have to encourage people to find a way to find a friend of a friend of a friend or somebody in their network that they can convince to make that warm intro. But at the same time, we've been talking about it within our team a lot recently, because we want to be more supportive of the underrepresented entrepreneurs and people, entrepreneurs that are equally as strong and have great ideas and great execution, but may not live in the Bay Area or in the typical centers of where entrepreneurship and VCs live in, or have, by background, don't have that access. So it's a balance. We've been making effort to be more open to other ways of connecting with entrepreneurs.
There's a couple of networks that are forming amongst networks of, to support sort of underrepresented groups. So the Valence Network, Kobe Fuller out of I was one of the early people working with Kobe when he set that up, one of the founding people in that group. And the main thing that those organizations do is actually provide a network to meet people, but Christina, you made a really important point there.
Great. Okay, so we'll take this last one and then we'll move to our breakout because it's almost 6:10. It says, I'm a SaaS company and I recently spoke to a mom and pop VC firm who asked me to file a patent for our tech. Knowing that it's almost impossible for SaaS companies to get patents approved, should I avoid working with VC firm that isn't too familiar in the tech space, but are experts in this space our tech is targeted to?
Personally, I would run,
Yeah.
Because that feels like a waste of time. I mean, they may be great clinicians. You might want them as advisors, but as your core investor group, I mean, having you file a patent at that stage of the company, that's a waste of time and money, in my humble opinion. And so yeah, I would run.
Oh, I would run. Okay, good. Christina, there's a question for you, but I think we'll just move that question into the breakout room. So at this point, first of all, thank you, all three of you, the whole panel, for a phenomenal job. Thank you so much for taking, one, the time, and two, sharing your insights. These were extremely valuable. At this point, what we'll do is I'll create 2 breakout rooms. So for folks who want to stick around, just in the chat box, let me know which room, either Christina or Ken, because I know Abhishek has to drop off, which room you want to be part of, and then I will assign you accordingly. Thank you again. And for those who are going to be leaving us now, be safe, be well, have a great rest of the evening, and thank you all for attending.
No, thank you very much. Great session, and great to see you, Ken and Christina, and great moderation, Anika. See you guys.
Likewise. Cheers.
Thank you.